Hi folks, this is the second in a two-part series about Tulip Mania, or the world's first financial bubble. In our first video, we talked about the inflation of the bubble, and in this video, we're going to talk about the interesting part, the deflation or the popping. So to give you a time frame, we are at 1636 to 1637 in the Dutch Republic, and currently, individual tulip bulbs of particularly rare varieties are selling for up to 10 times the annual salary of a skilled worker. So your tech employee making $100,000 a year, you've got tulip bulbs selling for $1 million plus. And what this has led to is this desire for widespread participation. You've got this bubble drawing in people from all walks of life, not just your merchants, not just your traders, but regular farmers who see their neighbors getting rich, on paper at least, with tulips, and they want a piece of the pie. And at this point, the financial system is still relatively new, and a lot of these folks do not have a good understanding of what these financial contracts actually mean, what they entail. And what this leads to is the creation of what's called paper wealth. So this is your NVIDIA or your tech stock on your computer screen that has gone up 200%, and you've got this big, beautiful green number that you're looking at and you're saying, oh, this thing is gonna run. I am not gonna take any profits. I am just gonna sit on my gains and let this continue appreciating. And the way this is working in the Dutch economy at this period of time is folks are taking these futures contracts and they are rolling them from one contract to the next and watching these paper gains accumulate and accumulate without taking any profits. And again, you can see where this is headed. Early 1637, you have the loss of confidence. Buyers are starting to back out of deals. Auctions are starting to fail. Tulips are going unpurchased. And what this leads to is a rapid loss of confidence in the tulip market. And what does a loss of confidence lead to in markets? It leads to panic selling. Prices are falling. That panic is truly taken hold, and everyone is rushing in to sell their tulips, to sell their tulip future contracts, but they're finding no buyers. And what does that lead to? It leads to prices continuing to fall further. And an important point of this particular panic was a legal chaos that was created as courts looked at these tulip future contracts and said, these are unenforceable. These are not legitimate contracts. We're not going to uphold them. And this is leaving folks with massive losses, going into debt. Now, in this particular time period, the Dutch economy was still broadly stable. And even the tulip panic did not create a recession in the broader economy, but what it did create was devastating losses. And those devastating losses were particularly centered around folks who were late getting into this tulip craze, who had bought these tulips at astronomical prices and now had absolutely nothing to show for it. If you think back to financial markets, the latecomers are typically the folks who are least informed, who are least able to bear those losses. And that truly is one of the worst parts about financial bubbles. So as we take some modern parallels, back in 1990 to the early 2000s, you have the dot-com bubble. This was focused on internet companies, the overvaluation of these internet companies, and simple speculative purchasing in business models that had not been proven. You look back to the 2000s and the housing bubble, a similar story. You've got housing speculation. Real estate is always going to go up. There's easy money, and you can take out risky mortgages to purchase homes that are overappreciated. And what I find interesting is when we look at today, so 2017 to now, you can see a lot of these same parallels in the cryptocurrency markets. You've got speculation in assets where the fundamentals are really unclear, and you've got that FOMO component. Everyone else is getting rich. How do I get in on this too? And the interesting thing about a bubble is it's almost impossible to identify a bubble in real time. It is only when you look back, you can look and say, yes, those mortgages were risky. Oh yes, those tech stocks were actually overvalued, because you know what the future earnings were. And for me, the takeaway here is understanding what the intrinsic value of anything that you're purchasing as an investment is. What is your investment buying in terms of future earnings or future cash flow? And then being very, very aware of potential herd behavior situations and trying to avoid that FOMO as much as possible. And I think the final thought here, history does not repeat itself, but it does tend to rhyme. And so one of the benefits of being a student of financial markets is having some of that context to look at situations and say, this feels a little bit familiar. If you have any questions, please feel free to let us know, but I hope you found this informative. Like I said, it's one of, I think, the most interesting parts of recent or relatively recent financial history.